Alright everybody, Logan Alec here. Today is 529 day. What is 529 day? 529 day is May 29th. Get it? May 29th. May is the 5th month, so 529. So now is as good a time as ever to talk about 529 plans. What is a 529 plan? A 529 plan is a tax advantaged college savings plan. All right, you can set one up for yourself, you can set one up for your kid, you can set one up for your grandkid, you can set one up for everybody, anybody, all right? Let's talk about what it is, right? So why would you need tax benefits to save for college, right? Well, how are those related? Well, let's back up a bit and let's talk about some other options that you can use to save for college, okay? First one, most simple way, set up a savings account. Put a little bit of money into that savings account every year for your kid's college fund, and then in 17, 18 years when he or she's ready to go to college, take the money out, say, here's some tuition money, right? Okay, I mean, that's a decent plan, but what's wrong with that plan? What's wrong with that plan is your money is not going to grow very much in there, okay? It probably won't even beat inflation, right? You're only going to make interest income at savings account rates on that, on what's in that account. So you're not going to make a whole lot of money there. So you say, okay, Logan, I know what I'm going to do. I'm not just going to save the money in a savings account. I'm going to invest the money. So you go to a brokerage account, you set up an account, or you might even set up a custodial account for your child, I don't know. You put the money in there, right? And then you say, okay, that money's going to grow in the stock market. It's going to have some nice growth, nice gain on it over the next 15, 16, 17 years. And then when my kid's ready to go to college, I'll sell the stocks in there and then, use that for my kid's college education. Okay, that's a little better, but here's the problem. Taxes, okay? Let's say you put $10,000 into that account over the years. Let's say you sell it, by that time the account has grown to $20,000, right? So you have a $10,000 gain. $10,000 difference between what you put in and what you took out, right, after you sold the stock. So $10,000 gain. Guess what's going to happen? You're going to pay a capital gains tax. Now, depending on your tax bracket, right, if you're still in your prime working years then, you could be looking at a 15, maybe even 20% tax on that $10,000 gain. Okay, so let's say it's 20%. Well, there's $2,000 to Uncle Sam right there. And let's say your state, unless you live in a state that doesn't have an income tax or doesn't have a tax on capital gains, you'll be paying state income tax on that income as well. If you live in a high tax bracket state and your income is relatively high, you could be looking at a 10% tax on that capital gain as well. So there's $1,000 to your state, right? So that nice juicy $20,000, right, in that account, due to taxes, net, it's only $17K. Sure, you can sell for 20 and then, use it for your kid's education, but you're gonna have to pay Uncle Sam, $2,000 on the back end on your state $1,000 when you file your taxes. So that's not that great either. Then you say, okay, Logan, well, I know what I'm going to do. I'm going to set up a UGMA account or UGTA account for my kid, right? That way, I hear there might be some tax benefits, like the first, a little bit of income is not taxed. Well, okay, let me explain to you. So with those kinds of accounts, the first $1,100 of unearned income per year is tax-free. The next $1,100 is taxed at your kid's tax rate, which might very well be zero. But then beyond that is taxed at the estate and trust rates, okay? And those long-term capital gains will be subject to that 20%, right? Long-term capital gains rate, just like it was, as though you had, put it in your own brokerage account, okay? It's called the kiddie tax, okay? So that's not the best tax strategy either, okay? Then you can say, okay, I know what I'm going to do, Logan. I'm gonna save for my kids' college in a Roth IRA, okay? Now, I love Roth IRAs for kids. It's a great strategy, right? But in order for a kid to contribute to a Roth IRA, right, they would have to have earned income. It's not like you can say, okay, I'm going to contribute $6,000 for you, kid, this year into your Roth IRA. It doesn't work like that, okay? The kid would have to have earned income, all right? If you wanted $6,000 into your kid's Roth IRA this year, they would have to earn at least $6,000 this year. That's a problem if your kid is young, right? If your kid's young, unless they're a model or something, they're not making any money. They don't have earned income. You can't set up a Roth IRA for them because they don't have earned income, okay? And plus, with a Roth, if your kid does have earned income eventually, right, and Roth IRA contributions can be made, I'd rather that kid save that Roth money for decades and decades and decades and decades and decades until your kid's 80, right? Or something like that, okay? Not take it out prematurely in his or her teens or early 20s, right? Okay, so that brings us to the 529 plan. How does the 529 plan work? Well, the 529 plan actually works a lot like a Roth IRA, right? You put money in, and then it comes out tax-free if you use it for qualified educational expenses, okay? You don't get a tax deduction up front, at least on the federal level, similar to a Roth IRA, but that money will go tax-free as long as you play by the rules. And in this case, playing by the rule means use the money for the proper purposes, okay? So before we get into all that tax stuff, let's go over some basics. Who administers these 529 plans? So 529 plans are administered by the individual states, okay? That's why you might hear about a Utah 529 plan or a Nevada 529 plan, which are both great 529 plans, by the way. They got good investments in there. They're low fee. Those are great plans, okay? California 529 plan, New York 529 plan, or they can be administered by colleges and universities. Now, there are actually two kinds of 529 plans, okay? There's the savings plans, which is what I described previously, where you put money in, right, and it grows, and you can take it out tax-free if you use it for educational expenses. But there's also these prepaid tuition programs, and what a prepaid tuition program does is it lets you buy credits or tuition at universities today, at the cost today, okay? And then you can use them, or your kid can use them, or whoever can use them down the line when they go to college, right? But they've already been pre-purchased today at today's price, all right? What's the downside of these prepaid tuition programs? The downside is typically for a state's 529 plan that has this prepaid tuition business going on, they can only be used at in-state public colleges and universities typically. So they're far less flexible, right, than the savings plans, which I described previously, where you put the money in to the 529, it grows, you can take it out tax-free. That can be used at any college or university in the country, okay? So there's definitely less flexibility with the prepaid tuition programs, but there's also a downside to the savings plans, okay? Because what if you put all that money in, right, it's growing and growing and growing, it's growing great, and then the market crashes just when your kid's about to go to college. It's kind of like, people who put all this money in their 401k, their IRAs or whatever, and then 08 happens, the market tanks right as they're getting ready to retire, okay? And the difference between retirement and going to college is you could maybe put off retirement for a few years. It's not like your kid's going to put off going to college, right, for a few years because the market tanked. So that's definitely something to keep in mind. Now, to kind of mitigate that risk, what some 529 plans, the funds will do is they have some kind of this target date model where, when you're still 15, 16, whatever years away from your kid going to college, the investments in the plan will be quite aggressive, maybe even all stocks, right, which tend to have the highest growth in the long run, but are the most volatile, right? But then as your kid gets closer and closer and closer to going to college, the allocation of that portfolio becomes a bit more conservative, right? Something a little bit more stable, maybe some bonds or something, which theoretically would not be as volatile and subject to market swings. Okay, so that's something to keep in mind. But of course, if you have a prepaid tuition plan, you aren't subject to that market risk. What do I personally use? We personally have set up a savings plan for my son Hunter. Okay, but I'm not saying that's what you need to do. That's just what we decided. I encourage you to study this information, do your own research, and come to a conclusion. All right, so if you have a savings plan, what kind of expenses can be paid out of that 529 plan and the distributions would still be tax-free? So obviously college tuition, but there's other stuff too, including room and board, other mandatory fees imposed by the college, books, required software, computers. These are all things that can be paid with out of a 529 savings plan and still qualify for tax-free treatment. 529 plan distributions can also be used for up to $10,000 of K-12 tuition per year. K-12 meaning kindergarten through 12th grade. So I'm basically talking about private schools here. Okay, so you can take out up to $10,000 a year, from a 529 plan to pay for that plan's beneficiary's private school. Okay. that will be tax-free for federal tax purposes. However, some states impose a tax on 529 plan distributions used for K-12 tuition. Okay, Montana, for example. So if you're in Montana, you file a Montana tax return, and you take out $10,000 to pay for your kid's K-12 education, you're not going to pay any, out of your 529 plan, you're not going to pay any federal taxes on it, but Montana will impose a state income tax on the earnings, okay? In terms of prepaid tuition plans, they typically only cover the future cost of tuition and mandatory fees. However, some plans for additional fee allow you to add on packages for room and board to lock in the room and board rates today. All right, maximum contribution. What's the maximum you can contribute to a 529 plan in a given year? There's no limit, per se, on how much you can contribute to a 529 plan, okay? However, there are gift tax considerations, all right? Because money you put into a 529 plan for your kid or anybody else is considered a gift, all right? So how gift tax works is every year the government says, hey, you can give so much money to somebody else and not have to file a gift tax return, okay? In 2020, that amount is $15,000, all right? So if you put in $15,001 in your kid's 529 plan this year, you'll have to file a gift tax return, right? But you and your spouse can team up, okay? You can give $15,000, your spouse can put in $15,000, and that's good. No gift tax return required. But once each of you puts in more than $15,000 for the year, triggers gift tax return. Now, gift tax return for many people is just an administrative burden, okay? It doesn't mean you're actually gonna have to pay tax, right? Because what the gift tax return does is, you know, every dollar above the annual gift tax exclusion amount counts towards your lifetime estate tax exclusion, right? And this is a topic for another day, but basically you're gonna have to have an 8-figure estate before you're actually gonna have to worry about tax on your gifts or tax on your estate. Okay, so that's a topic for another day, but just, and look, I don't think I'm ever gonna have enough money to you know, contribute $15,000 in 1 year to my kid, or $30,000 between my wife and I, right? So this is kind of theoretical, I imagine, for most of you, but I just wanted to put the rules out there. Now, that said, at the state level, some state plans have a maximum that can be contributed in total per beneficiary. For example, Idaho's savings plan sets a maximum of $500,000 per beneficiary. Iowa's maximum is $420,000. Now, who can start a 529 plan? So it's usually, you know, parents or grandparents can start a 529 plan for children or grandchildren. But anyone can set up a 529 plan for anybody. You can set one up for yourself. Now, should the parents set one up? Should the grandparents set one up? You know, there are different student aid implications there, right? If it's in the parent's name, okay, then those assets will count as parental assets for financial aid purposes, okay? But any distributions out of a 529, the parent's name, or the child's name for that matter, will not count as income on the FAFSA. With the grandparents, it's flipped. Okay, with the grandparents, it doesn't count as an asset, but it could count to count toward the income piece on the FAFSA. Okay, and honestly, this is another benefit, right? Especially with the parentally held 529 over the UGMA, UGTA, right? Because the UGMA, UGTA, that income will count as students' income, okay, on the FAFSA, which is a lot worse, all right? So that's definitely something to keep in mind. How do you start a 529 plan? Well, I would first research your state's rules, okay? See if your state will give you a tax deduction or a tax credit. Some states give a tax credit, right, for contributing to your in-state 529 plan, right? Some states do this. Some states will even give you a tax benefit if you contribute to any state's 529, but those are a bit more rare, right? California, where I live, does not give a state tax benefit for contributions to the California 529 plan. So, you know, that's unfortunate, right? But your state might, all right? So I would recommend researching your state's rules about that. Okay, maybe I'll do a separate video on that, going state by state, but that would just make this particular video way too long, right? So I would start there to figure that out. One site that I would recommend, well, before I get to that site, let me say that, you know, Fidelity, right? They administer plans for New Hampshire, Arizona, Delaware, and Massachusetts. Vanguard, Putnam, there's these other brokers that all administer 529 plans. Okay, one site that I like, and that's the one that we used ourselves to set up a 529 plan, is called College Backer. Okay, why do I like it? Okay, because they make it super easy for your friends, family, whoever to contribute to your kid's 529 plan. Okay, they give you this nice landing page. All right. And someone can just go on that landing page, right? It's for your kid, and they can use their credit card or debit card or whatever to contribute to your kid's 529 plan, right? So let's say your kid's birthday rolls around, you have too many toys. You're like, hey, no more toys, please. If you want to, wish my kid a happy birthday, here's his 529 plan link. Go, make a contribution to his college fund there. I mean, aunt and uncle, they love that, right? They love that they were able to contribute a little bit to, the kid's college education. Another thing to look for, though, when you're comparing 529 plan is the fee. Obviously, the investments in the plan, but also the fees as well. When you're looking at any investment product, you really want to be wary of fees, because fees can really, really, really eat up into your return. Okay, those of you with 401ks, you got to watch those fees, not just the fees that are assessed by whoever's administrating the plan, but the fees on the investments within the plan. Right? That's a topic for another day. But check out College Backer. Right now they're offering a $25 matching gift if you sign up. So please sign up through my link down there below. It is an affiliate link. Right, so you don't have to use that link, but I would appreciate it if you do. It helps to support the channel, helps me to continue to create content like this. All right, so can you change the beneficiary to 529 plan? Okay, so let's say let's say you have two kids. Actually, no, that might sound a little not fair. Okay, let's say you have a kid, right, and the kid grows up, and you've contributed to this 529 plan for him or her every year, right? So you got a lot of money in this 529 plan. Kid goes to apply for college, and guess what? He or she gets a full scholarship to the college, his or her dream college, right? So what happens then? What can you use this 529 money on for? You can't use it on that kid anymore, because they don't have any educational expenses anymore, because they got a scholarship, right? I'll get a little more into the taxes in a bit, but basically, if your kid got a full ride, right? Let's say it covers everything, room and board and everything, right? So they have actually no college expenses. Okay, you can't use the 529 on them anymore. You're gonna have to. But what you can do is you can change the beneficiary on the 529 plan. Okay, and you can change the beneficiary in a 529 plan without any adverse tax consequences, as long as the new beneficiary is a member of the old beneficiary's family. Okay, and the definition of family is broad. Okay, so it would include your child, son, daughter, stepchild, foster child, adopted child, or any descendant of these. It would include a brother, sister, stepbrother, stepsister, right? So if you have two kids, you can change the beneficiary on your kid A's 529 plan to their brother or sister. It includes the father or mother, right? So you can change it to yourself, or your child's other parent. Ancestor of either father or mother. So hey, let's say grandma wants to go back to school, you can change your kid's 529 plan to be beneficiary to be grandma, right? Stepfather, stepmother, niece or nephew, in-laws, spouse of any of the previous ones, or first cousin. Okay, so let's say you have one kid and they get a full ride. What are you gonna do? You can change it to yourself, the beneficiary. You can go get another degree, or change it to your kid's first cousin or something. The government makes it flexible with your ability to change the beneficiary on the plan. All right, now let's talk about taxes. So do you get a tax break for putting money into a 529 plan? No, it's kind of like a Roth IRA, right? You don't get money when you put money into a 529 plan. You don't get a deduction on your 1040, okay, at the federal level. The benefit comes later when you're able to take out the money 100% tax-free if you play by the rules, okay? Let's talk about playing by the rules. So distributions from a 529 plan used to pay qualified educational expenses, like the ones I talked about previously, are not taxable. However, if your kid gets a scholarship or something, not even a full ride, just like a partial scholarship, like $1,000 or something, the amount of qualified educational expenses for 529 purposes is reduced by that scholarship amount. Example, let's say that your kid took $10,000 out of the 529 plan this year, okay? Because let's say his or her tuition was $10,000. So I thought, okay, tuition's 10 grand. I'm going to take 10 grand out of this puppy, right? And let's say the 10 grand, that includes everything. Tuition, room and board, all that stuff. But wait, let's say your kid got a $2,000 scholarship, tax-free scholarship towards his or her tuition. His or her qualified educational expenses are not $10,000 anymore for 529 purposes. Now they're only $8,000 because he or she got a $2,000 tax-free scholarship. Okay, so if they took $10,000 out of the 529, but they only had $8,000 of qualifying educational expenses after the scholarship, they're going to owe tax on that $2,000 right there. Okay, so you got to watch out for that. So tax-free educational assistance that would count towards this purposes obviously includes tax-free scholarships and fellowship grants, veterans educational assistance, tax-free part of Pell Grants, employer-provided educational assistance, any other non-taxable payments other than gifts or inheritances received as educational experience. Now, one thing to keep in mind, I kind of used shorthand before, right? But when I say that $2,000 would be subject to tax, what I mean is the earnings on that $2,000 would be subject to tax. Okay, because remember, you're not taxed on your contributions, right? Because you didn't get a deduction for them in the first place. The only thing you would be taxed on is the earnings on those contributions. So when you take money out, whoever's administering your 529 plan, you get a 1099-Q at the end of the year, or the student will, and it'll show you, okay, of the total distribution, here's the amount that's attributable to earnings, right? And so you have to take that amount and prorate it between the qualifying amount of the distribution and the non-qualifying amount of the distribution, and the non-qualifying amount of the distribution that was attributable to earnings, that will be subject to tax, okay? Hopefully your tax software or CPA will do this for you. I don't want to get into the nitty-gritty right now because this is just intended to be an overview, really. All right, so now let's talk about the 10% penalty on taxable distributions. So if you have a taxable distribution on a 529 plan, okay, like let's say you, but not the kinds I just described. Okay, so not the example I just used, but let's say you had a 529 plan and you took money out, the kid took money out to go on vacation, right? They didn't even go to college, right? They just took the money out to go on a vacation. Well, in addition to the taxes that will be owed on that distribution, the taxable distribution that's included in income will also be subject to an additional 10% tax, like a penalty, basically, right? Similar to retirement plans, okay? However, not all taxable portions of distributions are subject to the 10% penalty. Here's a list of exceptions, okay, to taxable distribution items that they would owe tax on, but that would not be subject to the penalty. They include distributions paid to the beneficiary or the beneficiary estate on or after the death of the beneficiary. That's unfortunate, but distributions made to a disabled beneficiary. Distributions included in income because the beneficiary received one of the tax-free education assistance items, right, that I mentioned previously, right? So the example previously, tax would be owed on the earnings on that $2,000 difference, but those earnings would not be subject to the 10% penalty, okay? Distributions made because the beneficiary attended a U.S. military academy, or distributions included income solely because the American Opportunity Credit or Lifetime Learning Credit was deducted from qualified educational expenses. Let's talk about the credits for now. So you can claim the American Opportunity Tax Credit, the Lifetime Learning Credit, or the tuition and fees deduction if you qualify in the same year you take a distribution from a 529 plan, okay? But you'll have to reduce the educational expenses, okay, by the amount of the credit or the deduction used, used in that tax year in order to come up with the amount of qualifying educational expenses for 529 plan purposes, okay? So, let's say that, the example previously, not only was there $10,000 original tuition and fees and whatever, $2,000 scholarship, but let's say, you, the parent, also took a $1,000 credit for those educational expenses, okay? You got to reduce that not just from $10,000 to $8,000 now for the $2,000 scholarship. You got to reduce it by another $1,000 to $7,000 to take into account the credit that was taken, okay? So if there was a $10,000 distribution out of the 529 plan, $3,000 would be subject to the taxation rules, right? So the earnings on the $3,000 would be subject to tax, but not the 10% penalty, right? Because they qualify for some of the exceptions that I mentioned previously, okay? So state taxes now. So since each state administers its own 529 plan, state taxability varies, okay? Some states, as I mentioned previously, give you a tax deduction for contributing to that state's 529 plan, or even another state's 529 plan. Some states obviously don't have an income tax, so it's not even a thing. Tax deductions aren't even a thing in those states. But other states that do have an income tax do not give a 529 tax break at all. Okay, California, where I live, is one of those states. There's no tax break for California residents, even if they contribute to a California 529 plan. So it really depends on your state. Maybe I'll do a follow-up video going state by state, but that would make this video quite long, so I'm not going to do that now. What about distributions from 529 plans? So, so they typically follow the federal rules, right? If you take out money from a 529 plan to pay for college, right, tax-free. But like I said, the one big difference is on the K-12 piece. Right, so while for federal tax purposes, you can take out up to $10,000 to pay for kindergarten through 12th grade education for your child, and it'll be tax-free. Many states do have the same rule on that, but some states, such as Montana, do not go by that rule. So you would have to pay Montana tax on the earnings portion of distributions out of a 529 plan to pay for K through 12 education. All right, I think this is a pretty sufficient introduction. Let me just go over real quick some pros and cons just to kind of sum up, right? So what are the pros of a 529 plan? A, tax-free earnings, okay? As long as the distributions are used for qualifying educational expenses, the earnings will be tax-free, right? There are some exceptions to that I mentioned previously, but that's a general rule. B, state tax deduction. Some states will give you a state tax deduction or even a credit when you make contributions to that state's plan or even another state's plan. Number 3, there are plenty of options to choose from for 529 plans. You don't have to live in a certain state in order to use that state's 529 plan. There are several different plans you can choose from, each with different investment options and fees, etc. Number 4, flexibility, right? The saving, not so much with the prepaid tuition plan, but with the savings plan, you can use money at any college, university, or vocational school in the country. 529 plan cons, there's no federal tax deduction for contributions made, kind of similar to a Roth in that way. Con number 2, if you have a prepaid tuition plan, it's pretty inflexible. Right, you're basically prepaying credit at specific colleges and universities. And number 3, it can reduce your financial aid package. Having a 529 plan can impact the amount of need-based financial aid you'll receive, but typically not as much as a UGMA or UGTA account would. All right, so that is my 529-day video. Hope I didn't get too long. If you want to set up a 529, I encourage you to research all of your options, and I would also encourage you to look up College Backer. Link is in the description, where you can get a $25 sign-up bonus on that. All right, so have a great 529 day. Have a great weekend, everybody, and I will see you next time. Bye-bye.